Today is Judge Tay and Judge Cho.
Morning.
Can I have the parties represent themselves, or introduce themselves, please?
Hi, my name is Jeffrey Jacobs. I'm the attorney for appellants Hense.
Thank you.
Hello.
David Call.
David Kowalczyk for respondent.
Marguerite Meunier for respondent franchise tax board.
Thank you. So right now we're off the record. I'm just going to cover some housekeeping items that we discussed at the pre-hearing conference. Then we're going to go on the record, and our stenographer will record everything that we talk about today. If at any time you're confused about the process, please just ask me a question and I can try and clarify. I'm the lead judge for the purpose of conducting this hearing, but my co-panelists here are co-equal decision makers. We have read your briefs and examined the exhibits that have been submitted thus far. Just a reminder that the Office of Tax Appeals is an independent agency. We do not communicate with either party unless the other party is present. And because of this position, we only have the exhibits and the arguments that you present during this appeal. Do we have any questions at this point?
No.
Great, all right. So the issue we have before us today is whether appellants have established a basis to abate the demand penalty and any related interest. Mr. Jacobs, is that accurate?
Correct.
Mr. Kowalczyk?
At the pre-hearing conference, we agreed that interest will automatically be recalculated based on whether the demand penalty is sustained or not.
Yes, I believe that's how,
Yes.
Mr. Jacobs, is that accurate? Okay,
Okay.
great. And then the exhibits that we discussed at the July 9th pre-hearing conference and described in the pre-hearing conference minutes and orders that you should have received are appellants 1 through 12 and respondents A through AA. Mr. Jacobs, do you have any new exhibits today?
I just requested, I sent in something, a new case that I was going to discuss.
Yes, we received that, and I saw that you were copied on that as well.
Yes.
Since that's just legal argument, I just put it in for our record.
Perfect.
Okay. Do you, Mr. Kowalczyk, do you have any objections to exhibits 1 through 12?
No.
Okay, great. And do you have any new exhibits today for us?
No.
Okay. Mr. Jacobs, do you have any objections to exhibits A through AA?
No.
Okay, we'll enter those on the record shortly. As for presentations, Mr. Jacobs, you will have 20 minutes, as we discussed, and then Mr. Kowalczyk, you will go after with 20 minutes as well. The judges may have questions for you, and then Mr. Jacobs, you'll have the opportunity for a final statement. Okay, any questions before we go on the record?
No.
All right, panel, ready? All right, we're going on the record. This is the appeal of Robert W. and Pamela M. Hense, case number 1807-3409. Today is July 23rd, 2019. It's approximately 10 o'clock. We are in Los Angeles, California. I am lead administrative law judge Sarah Hosey, and with me today are judges Daniel Cho and Richard Tay. Parties, can I have you state your names for the record?
Jeffrey Jacobs, attorney for appellants.
David Kowalczyk for respondent.
Marguerite Meunier for respondent.
Thank you. Today's issue is whether appellants have established a basis to abate the demand penalty. Mr. Jacobs, is that accurate?
Yes.
Mr. Kowalczyk?
Yes.
Thank you. So we pre-marked exhibits 1 through 12 for appellants and A through AA for respondent MTV at the pre-hearing conference held on July 9th, 2019. Mr. Jacobs, do you have any objections to admitting exhibits A through AA?
No.
Thank you. Mr. Kowalczyk, any objections to admitting exhibits 1 through 12?
No.
Thank you. Mr. Jacobs, do you have any new exhibits today?
No.
Thank you. Mr. Kowalczyk?
No.
Great. Exhibits 1 through 12 and A through AA are admitted as evidence into the record. Mr. Jacobs, are you ready for your presentation?
I am.
Please begin.
So let's see what really happened here. Appellate filed a return which showed a refund of $7,958 in 2014, and it ended up costing him $20,045 because of penalty and interest. So the issue is a reasonable cause. Appellant was employed in the state of California in 2014 while his family resided in Illinois, and he had $88,139 withheld from state income taxes, and he was entitled to an estimated refund of $7,958. As dated October 2nd, 2018, and indicated in respondent's opening brief, page 4, appellants previously filed timely tax returns for 2012 and 2013 as non-residents. However, attached in our respondents' exhibits V, W, Y, and Z, I'm not sure if Y and Z was actually, the actual exhibit was on there or not, all refer to duplicates for the year 2013 as not filed, even though the brief said it was. So my question is, why are there incorrect requests for tax returns for the year 2013 in respondent's brief for 2014? Anyone who would refer to these exhibits may think that the rest of the brief and demands are subject to question. By not filing and by not responding timely and properly to notices and demand letters, appellant CPA and CPA tax attorney caused appellants to incur an assessed delinquency penalty and a demand penalty totaling $20,045 based upon total tax liability without any reduction for California withholding. The Form 540 NR 2014 was received September 1st, 2016. Respondents Exhibit H. The final notice before levy and lien, dated 9/12/2016, Exhibit G, indicates a penalty code of AD. AD means failure to file by the due date and demand failure to file for a total amount of $22,835. So the failure to file by due date penalty of approximately $2,800 was abated when a penalty code A was removed from the notice of state income tax dated 9/26/16, Respondents Exhibit N. It did not state any reason for the abatement of the delinquency penalty file. My question is, why wasn't the demand failure to file penalty D, also abated at that time, September 26, 2016? The failure to file the return by the due date and the demand failure to file penalties were caused by the same inaction of their CPA and CPA tax attorney. The penalties were intertwined with similar facts and similar tax law. Although Mr. Hense was a non-resident when he was working in 2012, 13, and 14 in California, he went back each weekend for 3 years, approximately 150 times, to be with his wife and children, especially with his son Eric. Eric has a medical condition which includes malformations in the anterior and posterior portions of the brain. Plus, neurologists are undecided his corpus, these are all tricky words, callosum is present or is merely thin and difficult to identify. His condition prevents similar to cerebral palsy. Although appellants have never been given a simple diagnosis or description, such as within months of his birth, we're told that he may never walk or talk. However, over a period of 9 to 10 years, he attends school and he's had physical therapy, neuromuscular, and speech therapy. Eric walks, talks, plays, and attends school with normal children, albeit with the aid of a full-time aide at all times. His wife, who did not go to California to be with him, nor his kids, state in California had the responsibility to take the children to Eric for physical therapy and medical doctors. That's Exhibit 5. Appellants continue to use their current accounting firm, Marvin M. Siegel, CPA, PC, located in the state of Illinois, to prepare and file Forms 540 NR for 2012 and 13, which I previously stated were filed timely, and then subsequently 2014 in California. Marvin Siegel, CPA, PC, is an Illinois accounting firm and has a long-term relationship with appellants. The accountancy firm has two partners, Stephen Siegel, CPA, and Marvin Siegel, CPA, tax attorney with a master's degree in taxation. Appellants felt comfortable relying on their long-term representation with them and who were familiar with appellants' financial and family issues and specialized in taxation to prepare and file timely the 2012-2013 in California. Although the CPA firm was located in Illinois, the CPA Firm Mobility Act allows CPA firms to provide all services across state lines without having to register in each in which they offer these services. As previously stated, appellants were clients for many years with the firm and trusted their expertise in preparing their returns. Appellants exercise ordinary business care and prudence in choosing their tax preparers who they had confidence in and who they have used for many years to file the 2014 NR. This was not a frivolous, negligent, or illegal act. However, appellate CPA and tax attorney were not familiar with the requirement to file a timely file return in order to avoid late filing and demand penalties that were being assessed on the total tax, even though a refund was due in the state of California. Even a tax professional in the state of California who never had this issue could have overlooked this provision. This was a substantive issue. This was not a mathematical error. It was instead an erroneous interpretation of the law by appellates tax professionals, which appellants reasonably relied in determining whether or not they needed to file timely. Also, appellates, CPA, and tax attorney were not aware of the requirements to respond and the consequence to additional penalties and demand letters. There are several cases which indicate when reasonable cause comes into play. This one's a little tricky to name for me to pronounce. Rohrabo versus United States is cited in United States versus Boyle in the estate of Thuran. Both relied on taxpayer CPA or CPA tax attorney on a substantive issue, and had also, Thuran also relied on other medical serious illness as reasonable cause or hardship defense. In the additional case which I submitted, Rapito indicated that if taxpayer relies on improper advice of an accountant or tax attorney as a matter of tax law, failing to file, if there were two conditions met. The person relied on a tax professional with competency in the subject, and two, whether the professional advice was based on taxpayers' full disclosure of relevant facts and documents. Also, in Rohrabo, it indicated it is not the purpose of the law to penalize innocent errors made despite the exercise of reasonable care. Although appellant CPA and CPA tax attorney had competency in the subject tax law, taxation, and income taxes, they were not required to be familiar with all the California code provisions that required the requirement to file timely tax return in California in order to avoid late filing penalties and demand penalties even though a refund was due. The code provision in Illinois was different than in California. Appellate CPA and CPA tax attorney were also not aware of the requirements to respond timely to the additional penalties, notice, and demand letters. CPA and tax attorney submitted declaration of facts under perjury of law regarding these facts, Exhibit 11, I guess it is, Exhibit 11. Based upon the above court cases, appellants have reasonable cause and/or undue hardship defense. Appellants did not intentionally or negligently not file. They reasonably relied on their CPA and their CPA tax attorney on a substantive issue of whether or not to timely file. Based upon the reasonable cause or serious illness hardship based upon son's Eric medical condition, the demand failure to file penalty should therefore be abated and interest be recomputed. Thank you.
Great. Thank you, Mr. Jacobs. Do we have any questions from the co-payments? Judge Joe?
I have no questions at this time.
Judge Tate?
Mr. Jacobs, you mentioned hardship defense as grounds for reasonable cause for the demand penalty. I note that the demand notice in question was issued January 2016, and there was a deadline to respond of February 2016. Do you have any facts that support the hardship defense for that time period?
Well, it's the same all the way through. I mean, he was going back and forth during those periods of time. And there was still a hardship. It was indicated also in the declarations that the CPA and the tax attorney did get the documents, the notices, and did not respond. So they have been relying on them for many years. Prior to even 2012, they were clients. And these were clients who had sufficient knowledge of what they should do and what they should not do.
Thank you.
You're welcome.
In regards to the reliance on the CPA tax attorney, do you have any evidence of the specific advice that your clients received with regard to the response, any kind of response to?
So I did send an email that talked about it. But basically what happened was that Mr. Hense was in California working and all that stuff. And the accountants and the tax attorney said, look, we believe that there's not going to be any penalties, and therefore we don't have to file time, which was wrong. They made a mistake. They weren't right. And therefore they didn't proceed in gathering all the information that they could have gotten, because they did file timely in 2012 and 2013. So sometimes, well, first of all, they didn't keep good records either, because there was no documentation on that. When I asked them for it, to present documentation, they said, no, we never discussed it with him. So sometimes no documentation is the best documentation. They didn't converse with him. They didn't keep him up to breast. They were wrong in their analysis of filing the tax return. It was a mess.
Okay, and just to clarify, when you say they didn't need to file, does that include not needing to respond in any other way to the notice?
Well, first of all, the notices would come, and they would also come to the attorney and CPA. They didn't respond to them. So they did not realize how important it was. And taxpayers, appellates, they relied. I mean, they weren't involved in this. They've given them all the information to file 2012 and 13, even though they indicate that those records that I was mentioning said they weren't filed. 2013 wasn't filed timely. Those documents are very difficult to read, even if somebody were to read them. You have to know what the A means, you have to know what the D means, you have to do this, you have to do that. I'm not making excuses, I'm just saying that based upon the stress of being away and having to deal with the situation at home, the appellants did not look at the notices. The CPA's attorneys did look at the notices. They didn't respond appropriately. So, that's
Thank you. One just last point of clarification. When you said they didn't discuss it, do you mean that your clients did not discuss the notices at all with the CPA?
Well, the CPA got the notices. CPA got the notices. They should have responded properly. It's the same issue. First of all, this issue wouldn't have occurred if it would have been filed timely. Everything starts at the top. They didn't file timely, it got penalized. They got a delinquency penalty. But that was abated. Why was it abated? There's no record of why it was abated. And then after that, they filed a tax return and they continue to get demand notices. And those weren't responded to. Like I said, why wasn't the demand abated at the same time? It's all the same issue. If they would have filed timely, he would have gotten his refund. He would have had no penalties. Because of that, because of non-filing, he was getting demand notices. So also weren't responded to properly. And then taxpayers, appellates, kept believing in their accounts. It's all one thing. It started at the top, went to the bottom. It's all the same issue.
Thank you.
You're welcome.
Okay, thank you. Mr. Kowalczyk, I'm probably jumping ahead here a little bit, but since Mr. Jacobs brought up the abatement of the delinquent penalty, which we discussed at the pre-hearing conference, can you explain the reasoning for the abatement, Kavi's abatement of the delinquent penalty?
Yes.
Okay.
So because the taxpayers did not file a 2014 tax return on time, respondent imposed a delinquent filing penalty. However, once we received their tax return, the tax return showed that they were owed a refund because they had sufficient tax payments. So the way the delinquent filing penalty works is that in the calculation of it, if there are sufficient tax payments, those are taken into account when determining how much of the delinquent filing penalty will be imposed. And in this case, because they had sufficient tax payments to satisfy their tax liability, the delinquent filing penalty would have effectively been calculated at 0. And that's why the delinquent filing penalty was abated.
Thank you. If you'd like to begin your presentation as well, please. Sorry, I probably messed you up a little bit, but please proceed.
Thank you. Good morning. The issue before us today is whether appellants have met their burden of proof to establish reasonable cause to abate the demand penalty for tax year 2014. To establish reasonable cause, appellants must show their failure to reply to the demand for tax return occurred despite the exercise of ordinary care and business prudence. Appellants argue they established reasonable cause to abate the demand penalty because they relied on advice stating they did not need to file a timely tax return when they were due a refund. However, this argument fails because ordinary care and business prudence required appellants to timely reply to the demand and explain why they were not required to file a tax return. Appellants had a non-delegable duty to respond to the demand notice. In addition, appellants' argument that they didn't need to reply to the demand because they had sufficient tax payments to satisfy their tax liability also does not constitute reasonable cause. Appellants also argue they established reasonable cause because appellant husband spent a majority of his time traveling to and from Illinois and California for work. However, workplace pressures do not constitute reasonable cause, and appellant husband quit his job approximately 1 year before respondent issued the demand for tax return. Finally, appellants argue they established reasonable cause to abate the demand penalty because they have a child with physical disabilities. However, this argument also fails because appellants have not explained how having a child with physical disabilities continuously prevented them from responding to the demand notice. As stated in the appeal of Halliburton, medical conditions do not constitute reasonable cause unless the taxpayers were continuously prevented from responding to the demand notice. The only explanation appellants provided for why they did not respond to the demand notice was because the demand notice was either misplaced or thrown out, which are both not reasonable cause. Accordingly, appellants have not met their burden of proof to establish reasonable cause, and the Franchise Tax Board's action must be sustained. Thank you.
Thank you. Do I have any questions from the panel? Ms. Joe?
Yeah, just a couple of quick clarifying questions. In the earlier presentation by Mr. Jacobs, he was saying how the appellants had timely filed the 2013 tax returns, but it looks like FT's position is that those tax returns were not timely filed. Can I just get you to respond to that?
Yes, so respondent issued a request for tax return on April 22nd, 2015 for the 2013 year, and that's Respondent's Exhibit V. And also in Respondent's Exhibit W, we issued a notice of proposed assessment when they did not file a tax return in response to the request for a tax return.
Okay, thank you. Mr. Jacobs, do you have a response to that?
Yes, if it was filed timely, it was filed timely.
Do you have any evidence to support your statement?
Yeah, in the respondent's opening brief, page 4, it says appellants previously filed timely California returns for 2012 and 13 as non-residents. It's in the middle.
1 second, I'm sorry. So,
Can I clarify that statement? It says an appellant's representative stated that.
I see.
Yes.
I'm not sure what that says. It appears to me it says it's,
So it looks like FTV is just repeating your arguments in their brief?
I don't think so.
So other than this document, do you have anything else that
No.
would kind of support that?
No, but they would have to have the record to show that if there was a penalty assessed or not.
Okay, thank you. And then another quick question just to follow up is the calculation of the penalties. So from what I understand, FTV's position is that the delinquent filing penalty is measured off of the tax owed, and the demand penalty, what is that measured off of?
So the demand penalty is calculated based on the amount of tax that's required to be shown on the tax return without taking into account timely payments.
Okay, so is that the difference between section 19131 and 19133?
Correct.
Did you understand that, Mr. Jacob?
Yes, but my argument is, said before, is there would be no demand penalty if it was filed timely. It's the whole issue is a reliance on the attorney and the CPA. It's one issue continuing through the whole mess. That if you would have filed timely based upon the attorneys and taxpayer tax reps, right way to do it, there would be no penalty and there would be no notices.
Okay, thank you. That's all the questions.
So basically, I'm saying is, there was a reasonable cause to not file, and there was a reasonable cause to abate the demand penalties also, because it's all one issue.
Okay, thank you. Judge Tate?
Mr. Kowalczyk, to the question of reasonable reliance on the tax professional, I note that in your brief you cite to U.S. versus Boyle. I also note that that addresses a late filing penalty. Do you have any other cases that would apply the same standards to finding reasonable cause to the demand penalty?
Not in particular, but in this case, Boyle does not apply because the taxpayer, as appellant's representative has stated, the taxpayers did not receive advice regarding how to respond to the demand. And the only time they did receive advice was about 9 months before respondent issued the demand notice, and that was in regards to if they needed to file a return by the original due date.
You mean not specific written advice on whether or not there's a requirement to respond to the demand, or what do you mean by advice?
They did not receive tax advice on whether they needed to respond to the demand notice.
Although Boyle is, kind of the holding in Boyle is really more about the fact that there was a deadline, and the deadline is not really tax advice at all.
Yes, that is true, and Boyle also stands for the proposition that taxpayers do not have, or have a non-delegable duty to timely file their tax return. And in Boyle, the taxpayers relied on their CPA to file a tax return. And in that case, that does not constitute reasonable cause. But if they did receive advice as to a matter of tax law, then it could be considered reasonable cause.
If we were to find that there was advice about whether or not there was a filing, a response requirement overall, would that be subject to tax advice?
No, that would not be tax advice because it does not get to the issue of whether there needed to be a legal interpretation or a legal opinion. It's just merely following a deadline.
So you're saying that if the taxpayer received advice from their attorney saying you don't have to file because you paid enough and you're an Illinois resident, that's not subject to tax advice, is what you're saying?
Yes, that would not be substantive tax advice because that's merely a calculation of the amount of tax due, and it's not a matter of California tax law. If the attorney would to say that because of a certain provision in the tax code, such as whether they could be considered a resident or a non-resident, and then that might be considered substantive tax advice. But in this case, that would be merely a calculation of the tax due, and it doesn't really require a legal opinion to determine whether they would need to file.
I see you're making this distinction between a mathematical calculation, excuse me, as to whether a tax is due, versus whether or not they have a requirement to respond to the notice. That's the distinction that you're making?
Yes.
Okay. Okay, no further questions on that.
Okay. I'm going to bring up something a little different. As we were preparing for this hearing, we started talking about subsection B of 19133, specifically B2. B1 requires for the application of demand penalty whether the taxpayer fails to respond to the current demand for tax, which we're discussing now. But B2 also requires FTB to propose an assessment of tax after the taxpayer failed to timely respond to a demand at any time during the four taxable year period preceding the taxable year, which is 2014 here. And we were kind of discussing that language and what it means. And I know we didn't bring us to the pre-hearing conference, or it wasn't really ferreted out in the briefing. So if you'd like to respond, you're more than welcome to. But I'm thinking what I'll do is have post-hearing briefing on that specific issue, and I'll issue a order kind of explaining what I would like to, or what we as a panel would like to hear about that subsection. Mr. Kowalczyk, if you'd like to make a statement, you're more than welcome to, but I do believe I'm going to give each party a chance to brief it after the hearing today.
I will make a quick statement about that issue.
Okay,
if that's
go
okay.
ahead. Yeah, please.
So a literal reading of Regulation 19133, subdivision B2, provides that the demand penalty is properly imposed when the notice of proposed assessment is issued during the 4-year taxable period prior to the taxable year of the demand penalty. However, subdivision D of example 2 shows that demand penalty is properly imposed when the notice of proposed assessment is issued for one of the previous 4 calendar years. The United States Supreme Court and the California Courts of Appeal have explained that when interpreting a regulation, every word and phrase in the regulation must have meaning, and that the regulations in a whole must be read as a whole so that all parts are given effect. If there's an ambiguity in the regulation, then the courts defer to the agency's interpretation of its own regulation. In this case, Regulation 19133 is clearly ambiguous on when the demand penalty is properly imposed because Subdivision D is inconsistent with Subdivision D2. Respondent contends that Regulation 19133 should be interpreted similarly to Subdivision D, and that the demand penalty is properly imposed when the notice of proposed assessment is issued for one of the previous 4 calendar years. This interpretation is consistent with the history of the regulation. Initially, the California legislature conferred discretionary authority on a respondent to assess the demand penalty whenever a taxpayer fails to file a return upon notice of demand. And the respondent assessed the demand penalty on any non-filer. In response to public concern, the 3-member board adopted a policy to only impose the demand penalty on only repeat non-filers who had not filed a tax return in response to the demand notice for one of the previous 4 calendar years. Respondent subsequently formally adopted this policy in Regulation 19133, and the examples in Subdivision D show when the demand penalty will be imposed. Therefore, the panel should defer to respondent's interpretation of the regulation on when the demand penalty should be imposed. Thank you.
Okay, Mr. Jacobs, I know that was a lot, and so what I'm going to do is I'm going to have FTD do their post-hearing brief first. I'll give you 30 days since it seems like you have a good grasp on how you want to interpret that subsection. And then Mr. Jacobs, you'll have 30 days to respond, and then we will close the record at that point and then confer and issue a decision after that. So we are not ready to submit the case today. The record will remain open for the parties to address this 19133 subsection B2 requirement. I will issue an order laying out what should be discussed in the deadlines, but just a heads up, 30 days from today is about August 23rd, so I foresee that being Mr. Kowalczyk's deadline, and then 30 days after that is September 27th, Mr. Jacobs. So I'll issue an order laying out these deadlines, and we will go from there. I appreciate you guys your time today on this. I know there's a lot to unpack, but the hearing is now adjourned.
Wait.
Thank you.
Oh, I'm so sorry, Mr. Jacobs. Yes, you do have an opportunity for rebuttal.
Right. And that's a good one.
Okay, let's hear it.
So, I am going to respond to what he said. It was a lot of information that he gave us. And it seems to me that it's a substantive issue is what he's talking about. And of course, one of my things is a reliable, reasonable cost based on substantive issue. That is definitely a substantive issue. So I think I'm going to be in good hands with my response. The second thing is, yes, both appellates and respondents are relying on the same cases and the same facts for reasonable cause. One thing, however, that is very, very important is in this terrific case, Roabo, I don't know if I'm pronouncing it right or not, it specifically stated it is not the purpose of the law to penalize innocent errors made despite the exercise of reasonable care. Taxpayers, appellants use reasonable care. They relied on their representatives who are knowledgeable in taxation to file a tax return. That is a substantive issue. It is not a mathematical issue. Whether or not you have to file timely is an issue that's in the code, and it says you have to file by a certain date. If they made a decision not to file by a certain date, that's an issue of law. It's a substantive issue. Thank you.
Yes, thank you. Okay, as I stated before, we're not submitting the case today. We're going to leave the record open. I will issue the order laying out what we'd like to see discussed about the 19133 B2 issue, and I will lay out the deadlines for each party again, just so it's clear. Again, thank you for your time today.
Thank you.
And now, the hearing is adjourned. Thank you.
Thank you.
Joining me on today's panel, to my left is Judge Linda Chang, and to my right, Judge Sarah Hense, who you saw at the last hearing.
Good morning.
I know I went over quite a few things at the pre-hearing conference, so I'm going to kind of not go over that again. You know, OTA is a separate agency from FTP, etc. I do want to ask, before we go on the record, is everyone here who needs to be here today? Let's start with for the taxpayer.
Yes, my name's Chris. Yes, my name's Chris Hamilton. I am the only one attending today.
Okay.
Joe Angelo will not be here, and we will not be bringing a witness.
Okay, thank you. That was going to be my question later on. Okay, so I just want to cover exhibits and just go over the presentation times real quickly before we go on the record. So for the exhibits for this case, the taxpayer submitted exhibits 1 through 14. Is that correct?
That's correct.
Okay, and FTV received those exhibits.
Correct, those last two,
And
yes.
there were no objections filed.
No objections.
Okay, thank you. And then the FTV submitted exhibits A through Z. There were no objections.
No objections.
Okay, all right, so, great. And then the presentation times, I will talk for about 5 minutes introducing the case, probably less, and then taxpayer, you'll have 30 minutes, Mr. Hamilton, for your presentation.
Which I won't need.
Okay.
It'll be much less than 30
Okay,
minutes.
great, thank you. And then FTV, you'll have 10 minutes, and then Mr. Hamilton, you can have 5 if you'd like on a rebuttal, and then we'll close the record and adjourn. Sounds good?
Yes.
Okay. Okay, ready to go on the record, everyone?
Yes.
Okay. Okay, we are on the record. This is appeal of WP Haines Incorporated, OTA case number 180100986. It is Tuesday, July 23rd, 2019, approximately 10:48 a.m. We are in Los Angeles, California. My name is Kenny Gass. I'm the lead administrative law judge for today's hearing. Joining me on the panel is Judge Sarah Hense and Judge Linda Chang. At this point, I'd like to ask the parties to please state your names and titles for the record, starting with the taxpayer.
Chris Hamilton, CPA for the appellant.
Thank you.
Brian Working, tax counsel for respondent.
Marguerite Meunier, tax counsel for respondent.
Thank you very much. Okay, we have 2 issues for today's case. The first is whether the statute of limitations was suspended for the 1999, 2005, and 2006 tax years under Revenue and Taxation Code Section 19316, such that appellant timely filed a refund claim for these years, and if so, whether appellant is entitled to a refund of various penalties, interest, fees, and excess funds as applicable for the disputed tax year. For the exhibits, taxpayer submitted exhibits 1 through 14. FTP has no objection. Therefore, all of taxpayers' exhibits will be admitted into the record. But note exhibits 5, 6, 7, and 12 through 14 relate to arguments and not facts, and it will not be considered as evidence, but it will still be in the record. FTP submitted exhibits A through Z, and taxpayer has no objections to them. Therefore, all of FTP's exhibits will be admitted into the record. But note, exhibits O, P, R, and Y relate to arguments and not facts, and will not be considered as evidence, but are still on the record. All right, that brings us to our presentations, and Mr. Hamilton, you'll have 30 minutes, but before you go, I forgot to ask, are you going to be testifying any facts?
No.
Okay, so just arguments here.
Yes.
Okay. All right, well, whenever you are ready, you may begin.
Okay, and thank you for your time today to hear this appeal. I do appreciate it. I need to clarify I'm not an attorney, so your patience with me and not knowing all the procedures is greatly appreciated. I am a CPA who's been involved in tax preparation and compliance issues for almost 40 years now, and I'm also a certified fraud examiner. I'm involved in forensic accounting extensively at this point. There are 2 issues I'm going to address today. One is, was a timely refund claim made, and was the statute suspended under 19316. The 2 California Revenue and Taxation Code sections that are relevant today are 19306 and 19316. 19306 says in part, no credit or refund shall be allowed or made after a period ending 4 years from the date the return was filed. 4 years from the last date prescribed for filing the tax return, or after 1 year from the date of the overpayment, which period expires later, unless before the expiration of that period a claim therefore is filed by the taxpayer, or the Franchise Tax Board allows a credit, makes a refund, or mails a notice of proposed overpayment on a pre-printed form prescribed by the Franchise Tax Board. 19316 says in part, the running of any period specified in 19306 shall be suspended during any period during which that individual taxpayer is financially disabled as defined in subdivision B. Subdivision B reads in part, particularly paragraph 2, for purposes of this section, except as otherwise provided in paragraph 2, an individual taxpayer is financially disabled if that individual taxpayer is unable to manage his or her financial affairs by reason of a medically determinable physical or mental impairment that is either deemed to be terminal impairment or is expected to last for a continuous period of not less than 12 months. We're here today to talk about $250,000 that the state of California acknowledges they took from the taxpayer, and they acknowledge that that amount is not due to the state of California. This is not in dispute, which makes the rest of all of this whole thing actually even more remarkable. The taxpayer, in other words, does not owe any money to the state of California. There's no current, existing, or potential liability. Yet California is here today to continue to fight to keep money they know is not theirs. The evidence shows that the state killed a business and consigned a sick elderly couple to a level of poverty in their final days that could have and should have been avoided. Some actually could call this elder abuse. I wonder how each of you would respond if the all-powerful state took $250,000 away from your elderly parents when they were terminally ill, thus killing their ability to earn an income or to pay medical bills. The facts of this case are shocking. They offend any sense of reasonableness or equity. But more, this case shows the ability of the government agency to rig circumstances to their advantage. I'm going to be referring to Exhibit 13 and 14 in the remainder of my comments. Exhibit 13 gives a timeline of relevant financial events related to the 3 tax years we're here to address today. At the bottom of Exhibit 13 is a summary. The total tax we're talking about for the 3 years was $9,912. That's it. Penalties were assessed and paid, and those were about nearly 100% of the tax. Interest was assessed and paid, and that ended up being 38% of the tax. All the tax, all the penalties, and all the interest was paid. The state does not dispute this. In fact, the state does not dispute that all taxes, all penalties, and all interest for all years that this corporation existed have been paid. They've made no claim either that any of the tax returns that were filed were incomplete or inaccurate. Along the way, in this case, the Franchise Tax Board did their best to justify extreme behavior of now nameless, faceless bureaucrats. For example, the Franchise Tax Board issued notices of proposed assessments as detailed in their brief. As an example, 2005, they issued an NPA showing taxable income of $2.6 million with unpaid tax of $238,000. You can look at the record, the tax return for 2005, gross receipts, total cash flow for this corporation for that year was $496,000. And yet taxable income somehow was $2.6 million. 2006, their NPA showed taxable income of $1.8 million, tax due of $166,000. Again, gross receipts for the business for that entire year was $539,000. You can see Exhibit 13 for the actual taxable income and tax numbers. These are absurd amounts to justify seizing absurd amounts of money. Some would maybe call this fraudulent. I understand this is not the forum to deal with fraud, but fraud is the intentional misrepresentation of material fact that's relied on to the detriment of others. Well, after all that, Franchise Tax Board is intent on keeping it. So why are we here? We're here because the state of California insists that a timely refund claim was not made, yet in their own brief they acknowledge this is not true. A timely refund claim was made, but the state of California hid behind a rule that says if a corporation is suspended, then they get to pretend they didn't hear that request for a refund. Then once the corporation is released from suspension, the state believes they then get to say that the statute of limitations expired while the corporation was under suspension. So this is how the game is played. The government gets to seize the funds of a suspended corporation, but doesn't have to give the money back to a suspended corporation, even when they know they overreached. By any definition, this is a scheme completely controlled by the state for the state's benefit. Page 5 of the respondent's brief acknowledges that there were claims for a refund, but that they were invalid because the corporation was suspended. Page 7 of their brief says, and I'm quoting, "Because appellant's corporate status was suspended, the 2005 return filed on August 5th, 2011 cannot constitute a valid claim for a refund." That statement is footnoted referencing section 19307. I went and looked up section 19307. It does not say that. On page 6 of the brief from the Franchise Tax Board, there's a lot of discussion about suspended corporations, much of which is not relevant to this case. But to the point of whether they can actually take money but not return it to a corporation that has a suspended status, all I see as supposed authority for that is a 1956 internal legal ruling by the Franchise Tax Board. That might be Franchise Tax Board policy, but it's not the law. The Franchise Tax Board has not made a persuasive case that the law prohibits the refund of seized funds while the corporation is suspended, nor have they made the case that they could not have allowed a credit, I'm quoting section 19306, allowed a credit, made a refund, or mailed a notice of proposed overpayment on a pre-printed form prescribed by the Franchise Tax Board in accordance with section 19306. Further, page 5 of the respondent's brief also states, and I'm quoting, "Respondent was in regular, continuous telephone and or in-person contact with the appellants." You can imagine there was repeated and probably emotional requests for refunds, and we know that there was acknowledgement by the state that they did not owe $250,000. Why do I say repeated and emotional? The Franchise Tax Board was like the snake wrapped around the neck, slowly squeezing the life out of this corporation and the elderly and sick shareholders. And I actually think the Franchise Tax Board knew it. With $250,000 being held on account by the state of California, some nameless, faceless, vindictive bureaucrat saw an opportunity to take money and never return it. The Franchise Tax Board, I believe, lost patience with these taxpayers and decided to stick it to them. The timeline demonstrates that. By March 30, 2011, as it shows on Exhibit 13, the state had seized over $192,000. Someone somewhere had to know this was overkill. As noted earlier, all indications are that the decision was made to take this business down. 2 weeks later, they published the name of the business as one of California's top delinquent tax debtors. So just in case starving the business of all of its cash doesn't kill it, perhaps destroying their name and reputation might. And based on that publication, these taxpayers decided to move out of state. They were utterly shamed. And part of the shame of that is that the Orange County Register showed a ridiculous amount of money due to the state of California, $607,000. You look at Exhibit 14, there is no year in which the taxpayer showed anywhere near that much taxable income, much less tax. In fact, most years you'll see their gross receipts were at or below that number. But California wasn't done. Between April 14, 2011 and August 2, 2011, the state took another $45,000. The business was dead. Exhibit 14, you can look at it, shows that the company never made another dollar of profit and in fact lost huge amounts of money and eventually closed. What significant illness and age didn't do to the taxpayers, the Franchise Tax Board did. That brings us to 19-316. Was the taxpayer financially disabled by reason of a medically determinable physical or mental impairment that was deemed to be terminal? I'll be blunt, unlike the rest of my statement. They're both dead. Their impairment was caused by terminal medical issues, compounded by the relentless difficulty of not having access to their own money. They were both on chemotherapy, as the evidence shows. They are unable to address day-to-day issues. The business continued to limp along and operate, but there was no ability of the shareholders and managers to provide oversight, accounting, and nobody denies that they did not comply timely with tax rules. It's interesting to note, the state has not made an issue, and they can't, that there was ever a history of filing issues until the period beginning with the 1998 tax year, when it's documented that there had been a diagnosis of cancer. So, I'll summarize. California suspended the corporation for non-compliance during a period when the taxpayers were mortally ill. The Franchise Tax Board knew this contemporaneously. Those illnesses eventually killed both of the shareholders. California seized more than 11 times the amount of tax, penalties, and interest assessed for the 3 years in question. California also very publicly slandered the business and the taxpayer and the shareholders with a vastly overstated claim of taxes due. Taxpayers were, by their own admission, in regular and continuous contact with the state of California. They weren't running, they were not hiding, they wanted to comply, and they wanted their money back. California now claims that all those requests for their money back in that period don't count. They even try to make it appear as if those requests didn't happen. California finally released the corporation from suspension at the end of 2014, having never issued a credit or a formal written notice of overpayment. Nothing prohibited them from doing that. Within 100 days of the corporate status being revived, a formal request for refund was filed. And California, like it always knew it would do, said, sorry, the statute of limitations has expired. And here we are in 2019. The state continues to tighten its grip on money that they know is not theirs. I must say that the Franchise Tax Board people I've dealt with on the short time I've been involved in this matter have been professional, empathetic, and human. There was none of that on the collection side and the enforcement side on this case. And I recognize nobody in this room had anything to do with the series of events I've just described, but the people in this room can, however, right a very terrible wrong. Thank you.
Thank you, Mr. Hamilton. FTD, whenever you're ready.
The facts in this case are not in dispute. Appellant is a corporation. Appellant filed its claims for refund for the 1999, 2005, 2006 tax years on April 10th, 2015, which respondent denied as being barred by the statute of limitations. The threshold issue in this case is whether the financial disability statute, section 19316, applies to corporations such that the statute of limitations could be told for a period of time which could render appellant's April 10, 2015 claim to be timely. At the pre-hearing conference, appellant conceded that its claim for refund is barred by the statute of limitations under any other legal theory. In limited circumstances, only applicable to individuals and not applicable to corporations, section 19316 will suspend the running of the statute of limitations during any period in which an individual taxpayer is financially disabled. The statute's conditional language makes it clear that its provisions only apply in the case of an individual taxpayer under the personal income tax law, Part 10 of the code, and do not apply to a corporation. The word individual is defined as a natural person under Part 10 of the code in section 17005. Appellant is not a natural person. Appellant is a corporation. Federal courts, in interpreting the analogous federal financial disability provisions under Internal Revenue Code section 6511 subsection H, for which the California Financial Disability Statute is patterned after, have found that the financial disability provisions only apply to an individual taxpayer and cannot apply to a corporation. In Lawrence S. Deutsch, MD and Associates v. U.S., Civil Action Number 165257, the court found that even though the individual who was the sole officer and sole director of the professional corporation was financially disabled, the tolling under section 6511 only applies to an individual taxpayer, not to a corporation. The court explained, though it may be true in the everyday sense that Dr. Deutsch, as the medical practice's sole officer and sole director, was the medical practice, that has no bearing on whether the medical practice can seek refuge under 6511H. The court found that because the professional corporation was not an individual, 6511H could not toll the statute of limitations. Respondent is sympathetic to appellant's circumstances in this case, but unfortunately the financial disability provisions do not apply to a corporation because a corporation is not an individual under Part 10. The secondary issue of whether appellant has met its burden to establish reasonable cause for the abatement of the demand, corporate demand, or delinquent filing penalties, or any basis for the abatement of the post-amnesty penalty, estimate penalty, filing enforcement fee, lien fee, or interest. Appellant has not met its burden to establish a basis to abate any of these penalties, fees, or interest, and respondent has fully briefed this secondary issue and relies on its arguments provided in its brief. Thank you.
Thank you. Thank you. Mr. Hamilton, you'll have 5 minutes if you'd like on rebuttal, and then we'll open it up to questions from the panel.
Okay.
Thank you.
I'll just say one thing. The opening statement, or the opening sentence, I think, that there was only one formal claim for refund and that it took place in 2015, not only is not true, it directly contradicts, as you can see for yourself, their own brief, where they repeatedly state that there were claims for refunds within the statute of limitations period, that they did not consider as valid claims for refund only because the corporation was suspended. I still do not see, I see procedural precedents, I see no law that says that they could not have issued a refund of funds they clearly know. And the one line that he just said is the one line in their brief, they're sympathetic. That's really nice, but they destroyed a business and this elderly couple died unable to pay bills because the state of California wouldn't give their own money back. It was asked for well before 2015. The state acknowledges that in their brief. Thank you.
Thank you. All right, questions from panel members? Okay.
Mr. Hamilton, can you explain how or why 19316 should encompass corporations in addition to individuals?
I think it's obvious that a small, closely held business, that corporations are people, and I heard him reference a federal revenue code section and legal precedents as opposed related to a federal or an IRS position. I don't think there's any separation between the taxpayers whose money was actually taken and the corporation. I think it's a legal distinction without any difference.
Okay, thank you.
Yes, thank you. No more questions.
Okay. Judge Chen?
No questions.
Okay. I have
Two questions. First, one for the taxpayer. I was a little confused in your presentation. You talked about IRC section 19306 about the general statute of limitations to file a refund claim. When we had the pre-hearing conference though, I thought that was conceded, that there was no timely claim for refund, and the sole issue we have here is whether 19316 tolls the statute.
I was utterly confused, and I think other people on that call were also confused by what happened on that call.
Okay.
My point in that call, and to this day, is we are not challenging the penalties, we're not charging the interest, we're not challenging the assessed tax. What we're saying is the Franchise Tax Board has money that's not theirs. When you consider all of that everything's been paid, what I conceded in the conference call was all of those issues, and I conceded that I understood the basis of why the Franchise Tax Board was saying there were no timely refund claims. But in that, I'm saying it is obvious to me as you read their brief, there were timely refund claims. They just didn't, they got to pretend like they didn't hear them.
Okay. Okay, understood. So the 19316, you're saying this, the statute was told?
Yes.
Such that there were timely refund claims?
And I'm also saying that I want the panel to understand that these taxpayers were begging for their money back well before 2015.
Okay.
If you just hear the statement that was just stated, taxpayers didn't ask for it till 2015. That is not the case.
Okay. All right, thank you. And for FTB, in Exhibit U, and I think it was in your opening brief too, I'm just a clarification on the interest amount for the 2006 tax year. What is the interest that was paid that was subject to potential refund claim?
Yes, I do have that number for you. For the 2006 tax year, the amount of interest that was paid is $2,239.39.
Okay, so it's not the $2,236.97. That is on page 1 of Exhibit U.
Let me double check that.
I just wanted clarification.
I see now, and I actually I think that number that you cited, the $2,236.97, I do believe that is the correct number. I think the discrepancy in between the two may have been a written off dollar amount.
Okay, so that's the correct number?
Correct.
Okay. All right. That is all my questions. Anything else from the parties? Okay. All right, well with that, this concludes the hearing, and the judges will meet and decide this case based on the documents presented and the arguments we heard today. We will aim to send our decision within 100 days of today. The case is now submitted, the record is closed, and this hearing is now adjourned. Thank you.
Thank you.
Thank you. Oh, yes.